Let's get back to the market, see what the charts are telling us. I was talking sentiment, but my next guest follows the tape. Tony Sycamore from IG joins me now. Nice to see you, Tony.
Thank you, Nadine.
I showed that market heat map earlier. You couldn't help but notice the tech names getting smashed. So what does that mean for your view of the Nasdaq?
Well, you summed it up accurately. You mentioned that geopolitical tensions are firmly back on the radar. Compounding that, we had an implosion in the Japanese bond market, and that's flowed through into the high beta Nasdaq. Now, one of the first things I noticed after coming back from vacation was the divergence between the three key US indices. The S&P and the Dow had made new record highs for the year, but the Nasdaq was lagging. And this has then played out with the Nasdaq gapping lower through the January 2 lows this morning. And we now can see that there is some significant technical damage to this Nasdaq chart here. So for me, we're looking for a pullback towards that 24,647 low back there in late November. But I do think that this is probably going to lead to a deeper flush, and we probably see a test of the support area around 24,200 to 23,800. So I think there's been significant technical damage done. As we mentioned, there were some hints of it with that divergence, and now we're seeing that follow through playing out today and in the Asian session.
So I note in yellow, you've got the 200-day moving average. Lots of people follow different sort of moving averages. And there's been a little bit of publicity around the fact that the Nasdaq fell through, I think it was its 50-day?
Yes.
Oh, right. So why did you decide to paint on that 200-day moving average?
Well, people have their preferences. Some people like a 20-day moving average. Some go with a 50. I like the 200-day moving average. Just it gives you a really good feel on the longer-term trend. And really, from sitting on my time on FX desks, that's the moving average, which I noticed that the big model and systematic funds tend to really react to. So if you were to see a sustained break of that, that will generally lead to them going short. Not so obvious in the Nasdaq chart because it's still a good deal below where the current market price is. But we saw it in the euro earlier this week. It bounced off that 200-day moving average, and it's then exploded higher in the two sessions after that. So it's definitely one that I keep an eye on and one I think is worth watching.
But if you think that there's been I just want to flush this out. If you think there's been technical damage done, where was your sort of support level, or where you think it would be even more destructive if it broke through? That's still above that 200-day moving average?
Absolutely. I mean, the longer term trend is firm. We really haven't had a down year in the Nasdaq since 2022. So we're coming off some pretty good years there. So the long-term trend is still higher, but we're traders, we're looking at where this market goes. You know, a move of 5 to 10% is important. So in terms of where the next 5 to 10% is, I think it's lower. So if it was to break that 24,647 low you can see there, which was mid-December, then I think it brings us back down towards that November low, 23,854. So I'm not calling the end of the uptrend. I'm just saying that some heat has to come out of this rally. It's been a phenomenal move over the past 3 years, and a pullback of 10 to 15% isn't a big call. It's just a short-term move in the grand scheme of things, but it's one that can be extremely profitable if it's traded correctly.
Yeah, and I would say fundamentally, a lot of people over the past few days saying, look, Nadine, you know, a 10, 15% pullback would be really healthy. You know, we're due for one, and it will come.
Yes,
you know,
and maybe it's already underway.
Yeah, okay. Now, I chose the next chart before we get to the ASX because arguably, if it weren't for the gold miners, and if it weren't for the big miners today, you heard me talking about the quarterly production reports, our market would be in a whole world of, you know, deeper hurt. So gold, I mean, this is the perfect environment for gold, isn't it?
There's none better. I mean, you've got geopolitical uncertainties, you've got bond markets, big bond markets blowing up, big, deep bond markets. And that has just played out perfectly for gold. Blasted through 4,700 overnight. The trend has been absolutely impeccable since it hit that 38.86 low. And you look at where it can get to next. Of course, 5,000 is probably the target, which a lot of people are talking about longer term. For me, you've got some trend channel resistance setting up there around 48.50. So I see no reason why in this current environment. And you have to also frame it in the terms of if there is going to be any walking back, it's probably not for a week or so. You remember the February 1st is the deadline for these new tariffs. So there's still some time for this to play out, you know, another week, week and a half. So in that time, gold can easily trade up towards 48.50. It could be there by the end of this week, but that's where I see the next upside resistance zone.
Really? Okay, so that is a support for the S&P ASX 200. But still, we're sort of at the mercy of those global forces. We're at the mercy of risk sentiment. We'll get to the dollar in a moment, but just tell us technically how the ASX is holding up.
Well, I think we're almost at the mercy of the materials sector.
Yeah.
So since the start of July, the materials sector rallied about 45%. In that time, the ASX 200 up about 3%, while the banks were down around 3%. Now, yesterday we saw a bit of a horror story for BHP. That has been calmed, those fears, by Rio's production report this morning. So in terms of what it does for the ASX 200, the rally that has occurred from those November lows has been in line with the seasonal strength we see between mid-December and mid-January. It's also been in line with the demand we have seen for our resource stocks. And I think Rio's production report today probably settles some of those nerves which were creeping into the ASX 200 at the start of this week. I expect 87.50 to be the key level for short-term sentiment, and providing it can close above there today, it keeps that uptrend intact, just keeping the focus on that materials sector and gold and uranium and those types of stocks, along with iron ore.
87.50. I am writing that down as a reminder right now, so I can look at that around 4 p.m. when we do the COB. All right, risk sentiment, Aussie dollar. It's been pretty favorable.
Yeah, well, you mentioned the US dollar, sell the US story playing out. And for me, it's not quite so clear on what that means for the euro, because if we are talking about tariffs on Europe, it's not good for their growth profile, which is already lagging well behind the US. But for the Aussie dollar, it has played out pretty well. I see the 66.60 to 66.70 as the key support area here. You can probably see there's potential head and shoulders top forming there as well. But as long as it holds above 66.60 to 66.70, it doesn't trigger that topping pattern. So for me, while it holds above that support zone, allow it for a retest of that 67.66 high we saw at the beginning of 2026. And then the next upside level is 68.50 to 68.70. So things look quite good here for the Aussie dollar.
Okay, so we'll keep our eye on the Aussie, obviously related to China as well. And there's been a bit of news coming from China. Now, I just read a headline saying Bitcoin's Fear and Greed Index flashes golden cross. What does that mean?
Golden cross is a cross between the 100-day and the 200-day moving average. So another technical indicator people like to look at for longer term trends. But for me, the trend is just summed up by the sell-off from the highs we saw there in October. The rally from the November low has been tepid. It has been a corrective, a counter trend type rally. It got up towards the top of the trend channel, which it has been following last week. And now it's spent the last 6 days trading lower to be testing the bottom of that trend channel support, coming in currently around 89,000. Now, while Bitcoin holds above 89,000 on a closing basis, you have to say that trend channel continue to meander a little bit higher. But if we do see a sustained break below 89,000, then it opens the way for a retest of that November low around 80,000. So that is it in a nutshell for me in Bitcoin. Looks tenuous at this point of time, this rally.